Okay, here we go. I'm going to look at Bobby 2 books. I want to go through a few administrative things first. I attached another course outline. By the way, everything that you see is going to be sent to you. So, on the course outline, otherwise known as the syllabus, I added virtual office hours as per instructed. Monday 10 to 2. Of course, this coming Monday is Labor Day. I'll be in Washington, D.C. But anyway, semester game plan. Obviously going to have the textbook to use as reference and so forth, and then I will make infrequent references to the textbook. You're going to receive illustrations. It'll be Excel files mostly, perhaps a couple of Word files. We're going to try to illustrate things and explain things, so you'll have that. And then you'll have what I'm doing right now, screen capture video, which my technical assistant, otherwise known as my son, tells me these files will be too big to send via email, so we're going to have to put them on YouTube. This is a virtual class. Is it as good as a traditional classroom? In my opinion, absolutely not. But we'll do the best we can under the circumstances. So, let's say you've read the stuff in the book, you looked at the illustrations, you looked at the videos, you have questions. Ask as many questions as you like. I've been answering a lot of technical questions in the last couple of days. I'm looking forward to answering accounting questions. All right. The only thing you're going to submit to me for grading will be comprehensive assignments, which will be 3 for the semester, and we are many weeks away from that at the present time. You will know when that needs to be sent, and you want to do your own work. The students last semester, they got the lowest grades, copied each other. Okay, AJE summary I already sent to you. So I may take a look back as we do Bobby 2 books. I organized the adjusting entries. There are more than these. These are usually referred to as accruals and deferrals. So that's what our topic is for now. Now, Bobby 2 books. That's a difficult problem. Hopefully I've got it all scoped out now, but here we go. Let's look at this. First of all, what are these balances up here? It says the unadjusted trial balance. It's not all the accounts, it's the accounts that pertain to this problem. Okay, so in a lot of cases, the information in this unadjusted trial balance you need to look at them in order to get to the right answers. All right, so let's take a look at letter A. Bobby sublet dumpster space to Lamco. Lamco made an advance payment to Bobby. No, Bobby got money up front. Up front of what? Earning it. Okay, this is an unearned scenario. So this is going to be one of these two possibilities. It's going to be a situation where you initially credited the unearned account when you got the cash, debit cash, credit unearned, or you initially credited the revenue account, debit cash, credit revenue. Okay, now how do we know which one it is? Let's go back. Let's see. He got $8,000. So we say to ourselves, self, is there an unearned rent account? And the answer is yes. That means what? That means this must be a 3A situation where we initially credited the liability account. You say, wait a second, it's $8,000. Why is it $4,800? Well, this is how all my problems work, at least these kind of problems. The assumption is we're doing monthly financial statements. Now, maybe Joe's Delicatessen doesn't have monthly financial statements, but even small companies like the ones that Professor Weinstein and I work with, they get monthly statements. So here we go. We started with $8,000 in the account, and that was for a period of what? 5 months. So like good solid accountants, we would have adjusted out for October and November $1,600 a month. That would have happened already. That would have brought our balance down to $4,800. That would have brought our rental income balance up to $3,200, which is, as the yuppies say, is what it is, right? So these are the balances on the unadjusted trial balance. And we we'll make one more entry for the month of December to reflect the earnings process for December. Debiting the unearned, crediting rental income. Now, if you want to coordinate with the adjusting journal entry summary, that's what it is, type 3A. And it's always going to look like that. It's always going to be a debit to the unearned and a credit to rental income. By the way, we're using the same rules we used in Accounting 1. Okay, just to show you that this is cutting edge technology. These rules haven't changed since approximately the year 1500, when Luca Pacioli devised the double entry accounting system. So how do you decrease a liability account? Anything beginning in the word unearned is a liability account. You debit the liability account. How do you increase a revenue account? You credit the revenue account. Okay, moving right along. What happened in letter B? Bobby got money up front again. How much? $21,600. At the end of the year, $8,700 remains unearned. That's another way of telling you the balance in the unearned account when we're done with our entry must be $8,700. So we say to ourselves, self, what is the balance in unearned? And the answer is 0. And what do we want it to be? We want it to be $8,700. So we're going to make an entry to create the liability account, which does not exist. That's money up front, initially credited to a revenue or income account. So that's where the money is, okay? It's in here. And we got to pull it out of there and create the liability account. So we debit fees earned for $8,700, and we credit unearned accounting fees for $8,700. That's a type 3B. How do you decrease a revenue account with a debit? How do you increase a liability account with a credit? Okay, here we go. Letter C. What happened here? Bobby loaned out $200K, 24%, 90-day note. And we got a note receivable up here for $200K. Okay, so we want to figure out, well, the money's owed to us, so something's been building up over time, and it's a good thing. It's interest income. So we do a PIT, principal times interest times time. Take the $200,000 note, the rate is 24%. Is that 24% a month? If you borrowed from a loan shark, maybe. Interest rates are almost always stated in the form of an annual percentage rate. So that's 24% for a year. We don't want a year. We only want 15 days. We want from December 16th to December 31st. So we multiply 200,000 times 0.24 times 15 divided by 360 equals $2,000. That's a type 4. Revenue or income is building up or accruing over time. Debit the receivable account, credit the revenue or income account. What just happened? What rules did we just use? We debited the asset account, we wanted to increase it. We credited the revenue account, we wanted to increase it as well. Okay, moving right along. What are we up to? Letter D is in dog, right? D. Bobby got $24K for annual subscriptions up front. Okay, that was back in August. So he's got to deliver 12 monthly newsletters. When he got the money, he debited his favorite account cash, and he credited, we don't know for sure until we look. So we go up to the top here, and I think I edited this, which is why I have it in red. Made a change off the version sent out, I don't know, last night or a couple of days ago, I can't remember. Anyway, we have an unearned subscriptions account. So this is going to be another type 3A, where the money came in, was initially credited to an unearned account. Okay, let's go back down here. It was $24,000. So that was the initial amount. And like good solid accountants doing monthly financial statements, each month 1/12 of the 24,000 was reduced. We reduced the unearned account by that, and we took the same amount into income over here. Okay, that already happened. That's why the balance should be 16,000 in the unearned account and 8,000 in the subscriptions revenue account, which it is. Yeah, this is 24K. 4 months already earned, 8 months not earned yet as of November. Now we go to December. What do? We adjust out another $2,000. Yeah. So there's your 2,000 for the month. Debit the unearned. Credit the revenue account. There's your entry. It's a 3A. And when we're done, what do we have? We have $14,000 balance in unearned subscriptions revenue, which should make sense. That's for the 7 months that haven't happened yet. And these are that's for the 5 months that did happen already, or the 5 newsletters, if you want to look at it that way. Here's your 24K. Alrighty then. What's up next? E is in Edward. Bobby paid. So when you see that, Bobby, or whatever company it is, they're paying money up front, you know you're in the world of a prepaid. So the question is, when you paid the money, you credited your favorite account, cash, you debited something. Did you debit insurance expense, or did you debit prepaid insurance? So we look at the top of the page again. The balance in prepaid insurance is 0. Okay, so apparently when we made this payment, we hit the expense account for the full amount. Okay, so what are we going to do now? We're going to create the asset. Doesn't exist. This is a type 1B. Okay. There's our balance before we adjust. We say, okay, 13.5 is for how many months? Better be 6. Yeah, November through April is 6 months. All right, so how much is that a month? It's $22.50 a month. 4 months remain prepaid. What 4 months? January, February, March, April. That's $9,000. That's got to be the balance in this account when we're done. We create the asset. We debit the asset account, prepaid. We credit the expense account. That's the 1B. I don't really like this method. I don't like the 1Bs or the 3Bs. But we just throw it out to you. What did we just do? We debited the prepaid account. It's an asset to increase it. And we credited the expense account. That's where this was initially charged. We want to decrease the expense. And there you have it. Next on the hit parade, what do we got? The advertising. Okay. WBAB, $97.50 is the amount paid. We're in the prepaid land again. I might have changed this. I got it in red. I'm not sure. I can't remember all the stuff. My head's spinning. Anyway, $97.50 divided by 3. That's $32.50 a month. It's 3 months. Okay. So we paid WBAB this amount in November, and obviously November's already by the boards. So what's the deal? Like good solid accountants, we paid $97.50. In November, we adjusted out $32.50, leaving us with a balance in the account of $6,500. That should be the amount on our unadjusted trial balance, which it is. Okay, so what do we want to do? We want to knock off another month. So we adjust out another $32.50 in December. There's our entry. Debit the expense, credit the prepaid. That's a type 1A. Okay. Initially, what was debited? The asset account, the prepaid. So at the end of the year or the month, the prepaid amount is the 1 month, which is January. When you're looking at prepaids and unearns, the balance in these accounts always has to be the amount on on the right side of the timeline representing, the part of the timeline representing the future. Okay. What's up next? G is in George. G. Bobby gets an electric bill in January, and part of that bill pertained to December. Okay. How much? $5,800. So what you have here is an expense that was sneaking up on you, accruing over time. You didn't record it. Why didn't you record it? Well, you didn't even have the bill yet, right? So now at the end of the year, we have the bill and we make an entry. We debit the expense account and we credit a liability account. That's the account you probably use in real life, accrued expenses payable. Now, probably some students would use utilities payable, which makes sense. But anyway, all right, debit the expense, credit the payable. Situation is what? You're at the end of an accounting period and you realize that there is some expense and related liability which you have not recorded for some reason or other, not by virtue of a mistake. And now what do? We put it on the books. We increase the expense with a debit, we increase the liability with a credit. That's a type 2, probably the most common type of adjusting journal entry. We're off to letter H. H is in Dirty Harry. Okay, says work in progress indicated $4,600 of fees had been earned but not billed. This is an unrecorded revenue or income item, which is one of these babies over here, right? So we got a debit, a receivable, and credit or revenue account. This is a good thing building up. We don't have to make a calculation because the amount is given. What's the amount? $4,600. So what do? We debit a receivable account. Now, you should find all the accounts in the unadjusted trial balance. There is such an account up there. Debit that account. What does that do? It increases the account. It's an asset. Increase the revenue or income account with a credit. Type 4 adjustment, according to the outline. Next on the hit parade. I is in Ida. Bobby was late on his rent, so he had to make a $37,500 advance payment. So Bobby paid money up front. You know you're in the world of a prepaid. What happened? What account did he debit or charge when he made that $37,500 payment? And the answer is must have been rent expense, right? Because the balance in prepaid rent is 0. We have to create a balance. Let's see what that calculation looks like. Come down here. All right, it's $37,500. It's 5 months. That's $7,500 a month. At the end of the accounting period, there are 4 months to go. 4 future months. Yeah? January, February, March, April. The balance in the account's got to be $30,000. It's 0. We debit the account for $30K, and we pull the $30,000 out of rent expense. That's a type 1B. There you go. Next on the hit parade. J is in John. Bobby's year-end inventory of crayons and other supplies is $3,700. It's another way of saying, you know what? The balance in the supplies account should be $3,700. That's what you counted. What is the balance in the supplies account? $8,950. We want that balance to be $3,700. What do? Come down here. Let's see what we do. Okay, the balance is $8,950. We want it to be $3,700. We need to knock off $5,250. So you just find the difference between these numbers and you make an entry, $5,250. This is an accounting 1 type adjusting entry right there, type 1A. Cost was initially charged or debited to an asset account. All right, where are we now? K is in Karen. K. Bobby borrowed. He owes $600,000 for 120 days, 6%. When did he borrow the money? December 21st. Okay. We look up here. What do we find? We find $600K owed to Scrooge National Bank. Okay. We owe the money. Yeah. You know what's been building up, accruing, sneaking up on you? Interest expense. So we got to make a calculational PIT action again, right? Come down here. Okay. 600,000, that's the P. Interest rate is 6%, and the time is 10 over 360. Why 10? We just want the last 10 days of the month. And I use 360 again, just to make the numbers come out even. In real life, especially if it was big money, more than likely use a 365. But anyway, if you multiply across 600,000 times 0.06 times 10 divided by 360 equals $1,000. Debit the expense account, credit the payable account. That's a type 2. Yeah? That's the second one of these in this problem. It's the most common type. What was the other one? That was the utilities expense, yeah? Debit expense, credit payable. They always look like that. Next on the hit parade is coming another type 2, which happens all the time in the real world. Bobby pays his employees bi-weekly, and they get paid on Friday, January 2nd for the 2 5-day work weeks that ended. 19,500. So I made up a little calendar down here. There it is. Okay, so this is when the employees get paid, January 2nd. They get paid what? $19,500 for the 10 days. That's $1,950 a day. At the end of the year, they've already earned, and by the way, you could be doing this at the end of any month, right? So that's not important for now. 8 days they've worked. Did they do the work? Supposedly. Do you owe them the money? You do. There's our expense payable again. That's one we did in accounting 1 as well. How do we get 15,600? Well, we multiply 8 times 1950. It gives us 15,600. There you go. Another type 2. Now, I've been speaking and illustrating a lot faster than I would ordinarily in a classroom, but one of the few benefits is that you could play this over and over again. You could slow it down, you can come back, and so forth and so on. Okay, when you look at this. Now, let's suppose that you wanted to print this out. All right, this is and you want it to all show up on one page. You don't want it to spill over into different pages. You'd go to the print function and you would choose the option fit to one. So that's how you do it. I don't want to do it now because I'm afraid what's going to happen in terms of this video. So I'll have to try that in another time and make sure that it doesn't blow up everything up. Okay, where are we now? We're up to Kerry Karate. What's Kerry Karate? That's another problem, okay? Similar to the one we were just looking at. Here are your unadjusted numbers, yeah? And then we have the information regarding the adjustments. So I want you to give this a shot on your own, and I'll send you the final Jeopardy answers. You can see how you made out next week. So that's about it for now. I am going to send everything that you're looking at or you've seen here in this video. I'm going to send it all to you in an email, and you'll be able to look at it, you'll be able to look at the video, and hopefully we can make some sense of this, okay? Signing off for now. Until next time.